Welcome to today's Learn at Lunch webinar series. We hope everyone is enjoying their summer. Going forward, we will continue on our regular schedule and hold one webinar each month. Today, Extension Specialist Roger Sauls will discuss Oklahoma pasture and land values. If you have questions, please ask them using the chat box in the lower right-hand corner, and Roger will answer them at the end of the webinar. For more information on farm management topics, visit the eFarm Management website. I will paste the address into the chat box. Roger, I will turn it over to you now.
Okay, very good, Brent. I really appreciate the opportunity to visit over the lunch hour and chat a little bit about the land markets in Oklahoma. Hopefully you're enjoying the little cooler weather today. It certainly beats the oven-like temperatures that we've experienced over the last couple of days. So at least over the lunch hour here and first part of this afternoon, I plan to give you some information and show you some slides that will explore some of the recent trends and patterns and some of the factors driving the land markets here in Oklahoma. We'll briefly review what's going on in the farm economy, how that translates into the ability to pay for farm ground. And I'll give you, I guess, my 2 cents worth as to where we might be headed for the remainder of 2019. Now, according to our study at OSU, the typical farmland transaction last year was about $360,000. So when you're spending that kind of money, good market information and analysis is critical. Our land value study provides a market-based assessment since it reflects a sample of the actual sales transactions that occur in Oklahoma every year. The more data points or the more sales tracks that we have in our study, the better it reflects the land transfer market. Now, the USDA NAS also provides information on land values, but their point estimates are survey-based, and so they look at it from a little different angle and different perspective. But I think that down the road in the information that I'll show you in a couple moments, our study and the USDA's results, I think they complement each other really quite well. Our sales data is provided by the Farm Credit Associations of Oklahoma, and we are certainly indebted to their assistance with our research and educational efforts. So before I go any further, I wanted to inform our listeners out there that according to the latest Ag Census, which of course was 2017, the ag real estate landscape in Oklahoma is comprised of about 1/3 cropland and 2/3 pasture ground. And so growing forage is big business in this state, and the livestock industry, typically cattle, like on this slide, is the major beneficiary that utilizes that forage base. In fact, when you compare cash receipts alone from crops and livestock statewide, 80 cents of every dollar received comes from the livestock sector. And so while the grain markets do influence the cropland values out west, it really boils down to the livestock economy and how well it performs and is expected to perform. That carries the big hammer, and that carries a great deal of weight on the real estate markets here in Oklahoma. So let's go into the numbers. And our study is a continual one that has been in place since 1971. You can see that it's been sort of a roller coaster ride over the years. The markets have cooled off after a pretty good run up in values over the past several years. And the land markets, they've leveled off mainly due to some reductions in farm incomes and some weaker credit conditions. I don't have the latest 2018 figures for net cash or net farm income for Oklahoma, but I do know that in 2017, net cash income was down 37% and net farm income was off by half. It declined 50% from that banner year in 2014. So I don't care how you measure it, when you take that much money out of the producer's pocket, that much money out of the ag economy, it impacts spending on the main street and in the ability to bid for land rentals and for land itself. And so the big question is, have we peaked for the time being, or what's going to occur down the road? And we'll talk about that a little bit more in this presentation. So let's go into the regionals. And I think overall the statewide values did increase a few percentage points in 2018. And then you can look at the regionals and, depending on the neck of the woods that you're from, you can see how those numbers compare to last year in 2017. I think there's once again, the regional differences in any given year can be rather substantial. And two areas that stood out, I think, when you look at this particular slide is in the Panhandle and in the East Central. And we can experience some rather high year-to-year variations in areas or regions of the state where we have less than 50 data points of which to analyze. And in this case, we had less than 50 sales tracts of which to examine. And so depending on any given year, it really depends a great deal on the cropland pastureland mix in that given year, the tract size, and the number of irrigated tracts from one year to the next, especially when you look at the Panhandle. Those averages can be greatly influenced by those above factors. And so then we move on to sort of a tabular summary of what's been going on in the markets by region, by land utilization since 2017 over the past, say, 5 and 10 years. I think there's several takeaways that you can take from this particular slide. There's a lot of information here. One is that, at least according to our study, cropland is actually at a discount a little bit to pasture. And there's several reasons of that. One I'll explain right now is that, we have seen 5 years of commodity price weakness in the cropping sector since 2014. That's no surprise to most of us. And in general, we've witnessed some cropland market corrections, I think, since they peaked in 2015, at least according to our study. And we'll talk about the Pastureland component in a moment, and we'll find out why those numbers are a little bit higher than cropland, at least according to our study. Another observation is that the markets in the eastern regions of the state have generally outperformed those in the west in recent years, especially over the past 5. The areas out west have given back some of those double-digit increases that they experienced earlier in this decade, at least in their cropland markets. One thing I'll say about the Panhandle region, once again, and in general, those areas that are irrigated, I have noticed more and more irrigated tracts bringing in excess of $3,000 per acre. Now, this is exclusive of irrigation equipment. And so that wasn't necessarily the case years ago, but I'm seeing more and more of that. And there's more and more ranch land on the market where the asking price not only reflects the earnings potential from running mama cows, but it also reflects some hunting, say, opportunities and some recreational interest. Another observation is that time can be a great equalizer. Over the past 10 years, regional performance levels seem to have leveled out by region of the state. And so that factors in, that over the past 10 years, the tremendous growth that we saw in the cropland markets were factored in. And also out west, we did see some capitalization into those land markets from the added liquidity from the energy sector. And we had some mineral owners and some royalty interests that decided to reinvest some of those monies in the local farmland markets. And so you can see in real estate, they say its location is everything, but you can say the same thing about the timing. If you bought cropland at the peak of the market several years ago, the value of that land asset, it's probably held its own. Some of your cropland areas where we have some less productive parcels, they may have lost value over the past couple years. If you bought cropland, say 10 years ago, its performance has been rather stellar up until recent. And if you bought pasture ground, its performance has been rather steady over the past 10 years. So I use a lot of annual averages in my analysis and information that I provide to the publics, but I also provide a 3-year weighted average. And the 3-year weighted average is a little different statistical procedure that I feel allows some improved reliability when analyzing patterns and trends over the years, since it tends to smooth out those year-to-year variations. And so the average values by year are weighted based on the number of annual sales during any 3-year period. So for example, in 2016, 17, and 18, that sales data is used to calculate that point estimate for 2017. So I utilize this procedure quite a bit in our website, and in reference to the Panhandle region shown on this slide, remember the big increase that we saw in 2018 as indicated by the blue line. Well, that's reflective of the volatility that we've seen in the markets, I think, in general since 2014. And so the weighted average, which is the brown line, tends to smooth out those annual variations as shown by that blue line. And I would surmise that the markets in the Panhandle have basically leveled off and are moving mostly sideways at this present time. So when I use that same statistical procedure for all of the 9 regions of the state, this is what we present, and this is what we see. The red hues represent the western 1/3 of the state, the greens the central third, and the blues the eastern third. And one thing you might notice is that in the eastern regions, they still show some upwards momentum, and the western regions tend to have leveled off. And so then we look at the cropland growing regions of the state, which is mostly west of I-35. And this basically reconfirms some of that leveling off and corrections that we've seen in the markets, especially in those cropland growing regions of the state. And so then we move on to, say, the pasture tracts in the state. And I think there's sort of a recurring theme here of leveling off in the west and some strength in the markets in the central and eastern portions of the state. I think there's another factor that's coming into play, and this has been going for some time now, is that many of the transactions in our land value database here at OSU, especially representing the eastern regions, are less than 100 acres in size. So a lot of these smaller acreages represent your smaller livestock operations. Maybe they have a few mama cows, a few horses, a few goats. They may have some cropland. That's probably more of the exception than the rule. But I call many of these smaller tracts some lifestyle operations, since many of these tracts are owned by part-time operators that may derive most of their livelihood from off-farm sources. They may supplement their livelihood from the farm, but most of their earnings come from off the farm. And they probably bought that pasture tract with some recreational interest as well. And so we are seeing more of this all the time, especially in the central and eastern regions of the state. So you may wonder how our values compare to USDA. And you can see here the trends are similar, but they're not identical since our sampling methods are different. So just think of it as looking at the land values from a little different angle or direction. Where we've seen a continued correction in the land or the cropland markets, at least according to our study, 2% in 2018, and also I think it was off 11% since 2015, since that peak. Now, according to the USDA, they've had a fairly steady upwards trend in those values. And in fact, they just released a report last week. I needed to update this slide even this morning that reflects a continued upwards trend, at least according to the USDA, of 2.5% going into 2019. So it'll be interesting to see, how OSU's numbers will shake out next year. If we will continue to see a convergence, looks like they're trying to match up, or if we're going to bottom out and trend back up as well. We'll just have to wait and see. Also, this is how our numbers compare to USDA's on the Pastureland side. And of course, you can see that our values are consistently higher. Once again, that's due to the fact that we just have a sizable percentage or portion of our tracts in our data set that are less than 100 acres. And so these smaller tracts are valued or priced, on the market several $100s higher than some of your larger tracts, either in the eastern region of the state or western region of the state that represent more of your commercial-sized operations. And so we do have that lateral shift going on, and also the USDA, according to their most recent report, continue to show some upwards momentum in those pasture land markets of about 6% going into 2019. And I think another clue as to what's been going on so far this year can be taken from the Ag Credit Survey from the KC Fed, and it shows that farm real estate values across this district were mostly unchanged from a year ago. That's the bottom line there. Now, of course, Oklahoma is part of that 10th district, and so the value of all the types of farmland, I think, declined modestly in Nebraska. It increased slightly in all the other states, including Oklahoma, except in the mountain states. Ranch land values were sort of all over the board. Declined 7% Nebraska. We're up 7% Western Missouri. And I think in Oklahoma, we saw some moderate increases really across the board, probably the strongest in the district. And this is on top of some pretty strong growth in the real estate markets, at least according to the bankers that were surveyed by the KC Fed, even in the first quarter. And so, at least thus far in 2019, according to the Kansas City Fed, that we've seen some strength in the markets here in Oklahoma. So, what's really driving the bus and what's driving these trends? And the future is pretty hard to predict, but we do have several clues as to, some indicators of impacting those trends. And the next couple slides, I'll touch on the farm economy, the commodity markets, the farm income as a result of those commodity markets, and the credit conditions, of course, in the state. So let's start off with, of course, the beef cattle sector, and I looked at the LMIC's sort of estimate on those cow-calf returns as sort of an indicator of where this industry is headed. Of course, we've seen some major drop-off in those returns since 2014 and 15. No surprise there. I think the margins are still pretty tight. Going into 2020, I think the returns are a little bit higher. They appear to be positive. But we're talking about average returns here. I think there are some producers that will make some really pretty decent money this year by working hard, but also working smart. And those that are working smart are keeping those financial and production records. I think they're managing their forage base. They're keeping, they're doing a great job of herd health. And they're really scrutinizing every dollar that they're spending on their operation. And that really makes a difference in your bottom line. And so going forward, I think that we'll continue to see some modest growth in the pasture land markets just because of I think the resilience really in the beef sector. We have, beef prices have really been pretty resilient despite the fact that we do have some increased beef supplies on the market. So I think a lot of it will boil down to, some of the export uncertainties as we go forward. But at least right now in Oklahoma, our forage base is in really good condition. And it'll depend on those hay supplies, of course, going forward as well. Now, looking at the cropland sector, I used wheat as sort of a proxy for, how the cropland markets are faring in the state. And since 2015, we've seen a major drop-off in grain prices. Of course, with average yields and lower prices, returns are marginal at best. Now, this year, fortunately, we did see some excellent crop yields. That helped lower some break-even prices, and it helped with returns above operating costs. quite frankly, it helped many farmers stay afloat. But I'm rather bearish about wheat and feed grains at this point in time because we're still in a low commodity price environment. We all know at $3 or $4 wheat, it's very difficult to make money. And while we've seen some months here of $4 plus wheat so far this year, the yields were pretty good to make up the difference in those gross returns. And so you essentially have to double yields to generate the same gross returns per acre as where we were in the first part of this decade. And so while prices are moving, mostly sideways, they're under $5. And I think until we're over $5 consistently, it's going to be, difficult, at least from my standpoint as an analyst, to be, say, optimistic about the grain markets and its resulting impacts on those gross farm incomes, and of course, then in turn on those cropland markets. And so, until we do see a turnaround, I think the cropland markets will be pretty resilient as well, and we'll get into a reason why that might be the case. But I don't think we'll see quite the strength in the cropland markets as certainly in the pastureland markets in Oklahoma going forward. And so, those commodity prices do have a direct bearing on farm income levels. The majority of the bankers across the district, according to the Kansas City Fed, continue to report declines in farm income during the first quarter. I don't have anything for the second quarter, but at least in the first quarter, this was the case. And now you can look at those index numbers on the side. And so an index of 100 means that 50% of the respondents reported lower incomes than a year earlier, and then the other 50% reported higher incomes than a year earlier. Now, of course, anything less than 100 means that more respondents thought income was lower than last year at this time. That was the case really all the way across the board, and Oklahoma is no different. And that can have some impact on some capital spending habits like buying some machinery, buying those capital assets, and of course buying some additional farm ground. And we look at interest rates, and fortunately we have been very blessed with a low and stable interest rate environment over the past couple years up until fairly recent. And we have had some trending back up in those interest rates over the last couple years. Those interest rates have been increasing on all types of ag loans in the second quarter. And so with higher interest rates, that does increase your operating cost. It does tend to squeeze those operating margins, and it increases those debt financing obligations of those capital purchases, especially land. And so that will also apply some downward pressure on the land markets going forward. So this, in combination with lower farm incomes and higher interest rates, well, that does tend to pressure weigh on those farm finances, and those credit conditions are a consequence of that. Many bankers continue to restructure debt, and then mostly we're talking about some operating loan restructuring and even deny some farm loan requests. Now, restructuring operating loans, for instance, it can help with your liquidity, issues, but the debt is still on the books. We're just, lengthening those repayment terms. And we have seen some of what I would call some encouraged sales of farm assets, of equipment, and some parcels of ground just to generate some, added liquidity to help with restructuring some of that debt. But we're not seeing, dumping of the capital assets on the market, certainly like in the 1980s. There is some capital out there, but it just really depends on how much of it is there in any given location. I'm watching to see, and I'm really waiting to see if there will be a few more farms that come up for auction this year due to financial reasons. The big question is how many will it take to put a little too much for sale on the markets in any given location. And so any further deterioration or worsening in credit conditions will have some downward pressures on the markets going forward. So really, I think in summary, despite all the headwinds that I talked about in regards to the overall farm economy, the farmland markets have been very resilient in Oklahoma. They have remained mostly steady. They've shown some increases, especially on the pastureland side. And I think, some of this is due to, fortunately, many balance sheets still out there still have some strong equity positions. And so while high yields have helped many wheat producers stay the course this year, it's when that working capital is gone, when we just can't cash flow and the borrowing against equity begins. That's when we run into really some big problems. That's the red flag. And of course, the balance sheet can get out of whack in a hurry. It's when there's no other recourse but to sell land. That's when the local real estate markets feel a brunt of that. And I don't see much of a turnaround in land values, at least some, stable, steady growth in these markets until projections for net farm incomes do rebound and credit conditions do improve. I see mostly sideways or cropland going through the remainder of 2019, maybe 2 to 3%. But there's a lot of uncertainty, of course, in the commodity markets right now, especially in the feed grains with the delayed plantings, with the projected yields that we might see. So there'll be some major volatility in the grains markets going through the remainder of this year. And I do see some modest growth in the pastureland markets, probably 4 or 5%, and that seems to be the case, at least indicative of what USDA and also the KC Fed has shown thus far. So I would encourage you to check out our land value website at OSU. It does contain I think a great wealth of information on the markets over the years. And so if you're a interested buyer or seller or just an interested party, I think there's some great information to be gleaned there. And I would complement that information with other sources of information on the land markets from the Kansas City Fed and from the USDA. And I think overall that'll give you a pretty good perspective of the markets, of which you can make some better decisions in regards to those purchases or sales down the road. So with that, there you have it. I hope I gave you the view or a feel and flavor of the farmland markets here in Oklahoma. And Brent did remind me to remind those of you listening out there to fill out that survey with that link down below. So click on that survey link or copy and paste that link into your web browser. We always encourage your feedback on how to make our webinars even better. And so that's really our goal of these webinars of meeting your needs and delivering the goods to you. So I really appreciate the time and attention that you've provided this afternoon. Thanks for stopping by. If you have any questions, I'll be more than happy to answer those. But short of that, thanks again for tuning in. Have a good rest of the day, and I'll turn it back over to Brent.
Thank you, everyone, for joining us today. We do hope to see you back in September for the next webinar, which is to be decided.